If you're here, you probably wonder what credit is and how exactly do I get started with credit. Well, today I'm gonna break it down for you. Let's go. Credit is essentially an agreement between you and a third-party source, which could be a bank or a lender that offers you money and you agree to pay it back. Essentially, when you initialize your first repayment towards this lender on a car or a loan, whatever it may be, this is when your credit score comes into play. All a credit score is a numerical version of your credit. Credit score can range from 0 to 800, with 0 to 579 being very bad, 580 to 669 being good, and from 740 to 800 being very good or excellent. How exactly do you get started with credit though? It's a big question that a lot of people have. Did you know that 30 to 40% of Americans don't even know how to track their credit score and know what their credit score is? The best recommended way to get started with credit for beginners is to get a secured credit card. All you have to do for this is go look online, apply for a company you see fit for yourself. They all have different deposit rates. Some of them start as low as $75 and can range all the way up to $1,000. But all you do is go apply for one of these and then you make the cash deposit and your credit line. With second on the list that you can do for beginners is finding a cosigner. This can be hard sometimes because a lot of people are kind of finicky with their credit and they don't want a lot of people on the lines. But if you can get a close friend, a spouse, or even a parent to co-sign you to, one of their loans, as far as a credit card bill, a car loan, or anything like that, this will tremendously help you out because it'll boost your credit history because they'll be making payments on that and you'll basically get props for it because you're co-signed up there. While this does boost your credit history, it doesn't necessarily boost your credit score because it's not in your name, but since you do have credit history now, it boosts your chance of approval because it's showing that you have showed signs of consistency and paying your payment. Lastly, which is the least recommended, I would say, it's not really a bad recommendation, but it's a route that you can take if you want to, but you don't really have to. The other two routes that I just explained are much better routes and more recommended because they can get you, your history faster and you can get credit started as soon as possible. With this recommendation, you can also get your credit started as soon as possible, but the chances for one of them is great, but the chance of approval for the second one is kind of iffy. You can get in, but it's a hit or miss. So the first one is you can get a credit builder loan, which is essentially you just go into a bank and they're just registering you for a certain amount, depending on what amount you choose. I believe they have different amounts, can range from 500 up, but you're basically just paying on that. You're just doing a payment plan on essentially the credit builder loan, and when you pay that, keeping track of your credit along the way. So all you do is it's basically like a monthly payment type thing. So think of it as a car payment. So you'll pay that every month, and then as you're paying it every month, they'll send that information to the credit bureaus to let them know that you're paying it on time or you're paying it late or however you're paying it. They'll send that to the credit bureau. After they do that, you'll keep paying on it until you finish the remaining balance or how much ever you register for it. And once you pay that, all that money that you did use or that you paid for on that credit builder loan, they'll give it back. Lastly, which is one that I'm saying the chances of approval are low, but you can probably get in for it, but you'll have a high interest rate, which is basically another small loan, which I would probably do if I was getting started. It's probably like something like a little small jewelry loan, probably something like from Pandora or something, probably like a little necklace or a ring or a bracelet or something that's probably like $200-300 tops. So you can get in on a payment plan on that. $100, I believe you could do it that way. I haven't really tried that before, so I can't really give you a 100% answer on that, but I do know like $200 to $300, minimum. So that way you can build your credit history. Because if you do get $100, for example, you go buy a $100 bracelet, you have a payment plan. I don't even know if they will allow you to get a payment plan on a $100 bracelet. I'll just be honest, I'm not sure. But I know certain pieces have payment plans on them, so if you can find about a decent amount, even if you do a 500 amount, it's going to be over to spend over a year, so it won't be that bad. So you'll probably be paying, if you get a $500 bracelet, you'll probably be paying around $40 to $60. And the only reason I say that is because they're going to have interest on that, and that's why I was saying if you get that bracelet, your interest rate is probably going to be high. That's why your chance of approval, you can get it, but they're going to give you a high interest rate. So you wouldn't really want a high interest rate on a $500 piece of jewelry, and then you pay interest and you're paying double that amount. That's why I said this is not the recommended way, but you can do it. So if you do that, you'll probably be paying $40 to $60 a month. It's not too bad, and it's a good way to build your credit history and build your credit along with it. So that's the last route you could take if you want to do that as well. Although there are a numerous amount of ways to start your credit, missing a payment or having a late payment will negatively impact your credit. This is one of the biggest things ever that you need to know. If you miss a payment, your score could drop tremendously. And if you miss a payment and you're just starting, that's not going to be good on your credit at all, because then it's going to be harder to keep building, because now you have a late payment and it's going to drop your credit score. And if you already don't have credit, it's going to be a little harder to build it up. So to maximize your growth in your credit, make sure you're always careful of when your payments are due, how much you're trying to use your credit on. So for example, if you're trying to buy $1,000 jewelry, but you know that you can't afford the payment plan that's on it, don't go and buy that, because one late payment could affect your credit. Go buy something that's more reasonable and you know that you can afford. Credit isn't here to just go, splurge and go buy things. For example, go buy $1,000 pair of shoes just because you have credit. That's not what it's really used for. You can do that, but you have to realize that if you do that, you still need to make those payments on time, and you don't want to just use your credit on just anything. Also, another thing with credit is when you use your credit and you're getting these things, you get things called hard inquiries. And when you get hard inquiries, those things stay on your personal record for 2 years until they disappear. So that's something you should know about. But the thing with the hard inquiries are, if you're constantly apply for loans, apply for use your credit for, you get a hard inquiry for it. And when they run your credit, it basically drops your score. So if you're getting multiple hard inquiries, you're going to consistently drop your score, and that's something that you really want to avoid. Because if you're getting consistent hard inquiries, basically the lenders are looking at like you don't have money to afford, so you're just using your credit for it. So when you're going to a bank or you're going to a car shop or anything like that, when they see that you have multiple hard inquiries, they're basically looking at you like you're just using your credit because you don't have the funds basically to afford anything. I would say it's a bad thing, but I wouldn't say I'm not going to say it's a good thing, but I'm not going to say it's a bad thing, because for some things, like if you are trying to, get a car or anything like that, you're going to get a hard inquiry, but the goal is to limit how many you get. So you don't want to have for me, I personally say you shouldn't have over 2 hard inquiries a year. The most times you get hard inquiries is when you're registering something with your credit, which is most likely going to be for a house or a car. Although you can use your payments on certain things, like for example, car parts or a bill or something like you couldn't afford. So you can use your credit for that. But when you're using your credit for that, you don't really have to run your credit. It's more so using your credit card. So it's kind of different. The way it's different for that is you're not running your credit. You're just using your card to pay for that, and then you're repaying it. Versus if you're going to get a house or a car, they're running your credit, and that's how you get hard inquiries. So getting your credit ran, basically when getting a loan or anything like that, they're running your credit, and that's how you get hard inquiries. Like I was just saying, credit can be used on multiple assets such as cars, homes. If you're late on a bill, anything of that nature, you can use your credit card for that, which is still tied to your credit. So how does credit really impact your life if you really think about it? Does it affect you? Like, why is it important to you? The main reason it's important to you is without credit, there's a lot of things that you still can do. It puts you at a disadvantage, especially in our society. And you're probably wondering why. The reason why I say this is, if you want to go buy a home and you have no credit at all, we'll just say, your chances of approval for a home loan are basically at 0%. Typical American, in which your average home doesn't have just $100,000 just to throw at a house. So it's like, how else are you going to get that house? And this is where credit comes into play. If you have credit, you have a higher, even if you have a bad credit score, but you have a down payment, you have a higher chance of approval of a home loan than with having no credit. And if you have great credit, you have a higher chance, which is basically from that 70 to 100% chance of approval of that loan. Lowers your approval of getting a home loan is based how much you're making a year and credit score. So what I mean by this is, if you're making $60,000 a year and you have a 600 credit score and you go apply for a $125,000 house, you're more likely to get approved because your income fluctuates with the price of that house. Now, if you were to make $60,000 and have a 600 credit score as well and try to go apply for a $400,000 house, your chances of approval are significantly low because your income. It's an income to credit thing. Even though you have good credit or decent credit, you still don't have a good chance of getting that approval because your income doesn't relate to that house. If you were to go apply for a $400,000 home, your chances of approval are significantly low. And the reason for that is that your income ratio to that housing is not, it doesn't compete with each other. So they don't see you as being able to pay that payment, thoroughly every month. So your chances of approval are they're low. So that's not something you would go use your credit for. You use something that's in your price range of your salary. Also with this, you can factor in the cars into play, because cars are also an asset that people use credit on a lot. For example, if a car is, we'll just say your car is about $25,000, without credit, you could get a chance of approval with banks, but without credit, what they do is, since you don't have any credit, are basically saying they don't trust you. So when the banks don't trust you, they give you a high interest rate. And when you get a high interest rate on a car that's like a newer year model, the cost of that could be super expensive. Like your monthly payment could be almost $500-$600 on that payment on just a $20,000 car. Versus even if you had basically a 400 or 500, maybe even a 650 credit score, your chances of approval are higher, and your interest rate for that car is going to be significantly lower than somebody who doesn't have any credit at all. So that's the best thing about credit, is you basically get a leverage around your interest rate if you have good credit, and with no credit, you're going to get an automatic high interest rate, and it's going to affect your monthly payment by adding almost, it could even double it. You never know, depending on the interest rate they give you, because with them, they typically, with newer models, they'll try to give you at least 15-17% on a new model, and that is crazy. So that's something you will want to avoid. So having credit branches you away from that. You still get an interest, not going to be as high as if you didn't have credit. Overall, credit is a very useful asset in our day of society, and it allows you to leverage the bank's money to your own personal will to pay that back. So as long as you do that, you're fine. But it's kind of like a double-edged sword in a way. If you do pay it, you're going to be great, but if you don't pay it, you're going to affect your credit negatively, and your credit score is going to drop, and that's something you don't want to do, because it's going to limit your growth, and it's going to take a long time to bring it back up. And if you made it this far, you're amazing. I hope all of y'all have a great day, and I'll see y'all soon.